I've described it as like rolling inflation. So it's not like we just have like a constant, equal level of inflation going up. Earlier this year, we had a lumber spike. I would describe that as a shallow inflation constraint because we didn't have a timber constraint. We just had a sawmill capacity constraint. Especially, the gold community has done that. The Bitcoin community has done that. There are people that only cover stocks, and all they are ever is bullish on stocks.
Right.
They're bond bulls. They're just nothing but bond bullish. They've never seen a bond they didn't want to buy, and so that's why I like to have that big framework in addition to subject matter experts. For the most part, yeah. So I would put myself on the moderate inflationary side of that debate. So I was expecting higher inflation than we've seen for a while. That was kind of my public position for the past couple years. We've really kind of seen that play out this year, right? So we got 5% inflation prints. We got some pretty, epic, kind of spikes, and part of that is supply chain issues. But every inflationary period has supply chain issues. That's
of course.
The whole definition really of inflation is you have monetary inflation, so money supply goes up a lot, and then you run into some real world constraint. So in the 1940s, that was commodities and labor. In the 70s, that was oil. We had basically U.S. production of oil peaked, and so we were more reliant on imports, while at the same time we had geopolitical issues with those exporters, and they didn't want to export to us, and so we had shortages. And of course, that translates into raising the prices of everything else. And so here in the 2020s, we find ourselves with such a complex global supply chain that combined with rapid increase in the broad money supply that kind of boosted demand back, we find ourselves with a bunch of real world constraints. And so I've described it as like rolling inflation. So it's not like we just have like a constant equal level of inflation going up. Earlier this year, we had a lumber spike. I would describe that as a shallow inflation constraint because we didn't have a timber constraint. We just had a sawmill capacity constraint. So turning timber into lumber, that's not a super challenging thing to solve. So that eventually rolled over. We've had a deeper problem is the semiconductor shortage because most semiconductors are made in a handful of countries, especially the high-end semiconductors. A lot of the companies you think of as semiconductor companies are actually fabless, meaning they don't make that themselves. And so there's actually only kind of a handful of major companies that are really responsible for a large portion of the semiconductors.
Right.
And so that's influencing all sorts of things like vehicles. And so we have used car prices skyrocketing. That might go the way of lumber. It already seems like it's maybe cooling off to some extent. We have, say, plastic shortages in part because of all these kind of weather events we've had in the Texas area, whether it's hurricanes, whether it's ice, freezing storms, unusual cold. And so, now we're seeing rent prices start to go up pretty strongly, which you'd expect from, housing, housing level prices went up quite a bit. Like I said, the broad money supply went up quite a bit. And so I think that's kind of the next leg up. Now, how long that persists after that will kind of come down to two things. One is labor, like wages, right? So it's hard to get sustained inflation without wages going up.
Yeah.
You see more and more signs of labor shortages. So one difference is if you look back in the 70s, you still had most of the labor was domestic. And so, you had a pretty tight correlation between productivity and wages going up. But because of offshoring and the United States running big trade deficits, we've been able to offshore a lot of our workers. So you have a disconnect between productivity and wages. Yeah. So that's been a pretty strong disinflationary force. But if we start to see kind of a period of reshoring, like let's say we've gotten costs so down because of this global supply chain, but we sacrificed resiliency to do it. And if we have a stronger imperative to increase resiliency, maybe at the cost of some cost increases going up, you can start to see wages push up to some extent. And so, overall, my base case is that I think we're in a somewhat inflationary period, but not necessarily in a straight line. And the other big variable would be if we get more rounds of fiscal spending, or if we go into a multi-year period of, say, political gridlock, where a number of countries, especially the United States, decide to hold off on stimulus for a period.
So how do you check your conviction in an idea?
I mentioned before those frameworks, and then I've kind of made those frameworks my own by doing, independent analysis and kind of, own data sets, and so now it's like my framework that's inspired by someone's framework. But
Right.
but then I follow people that have a different framework, and it might even be an opposing framework. It might say, we might obviously we live in the same reality, so it's not we agree on certain points, but we might disagree on say 70% of the points, or might majorly disagree on timings for things like that, or if obviously economics, really complex system, tons of variables, and so there could be disagreements about which variables are the bottlenecks, which ones matter more than others. And so it's really good, whatever your chosen medium is, whether it's Twitter or YouTube or following their blog or paying for their research, find people that are thoughtful but that you disagree with, so that
Right.
you should be able to articulate the opposite side of your investment thesis as well as you can describe the bullish case for it, I think. So that'd be my number one. And then two, I just, most successful investors, are just dispassionate, right? So obviously there's different, some people say that in order to get rich, you have to be concentrated and then diversify to stay rich. But also to get rich, you just never want to blow up, right? You never want to be over leveraged to something or too concentrated. So there's certainly a balance there where if you never kind of take conviction, you might as well, buy index funds and just, save time. But on the other hand, you don't want to be so exposed to something that you basically bet every single thing on a thesis, because
right.
Even the best, you can never really be more than say 95% sure on any one thing. No, I think that's a really good point. And I've seen that, for example, especially, the gold community has done that. The Bitcoin community has done that. There are people that only cover stocks, and all they are ever is bullish on stocks.
Right.
They're bond bulls. They're just nothing but bond bullish. They've never seen a bond they didn't want to buy. And so, that's why I like to have that big framework in addition to subject matter experts.
Yeah.
And generally, you can find subject matter experts that, you should actually find ones that have made bearish calls on their industry. That's actually good. We discussed before, what do you want to look for? That's something to look for. Are they a promoter or are they an analyst, right? Because an analyst, will talk about risk sometimes, we'll talk about downside. And so I think that's really important. And one of my approach is you kind of, in some ways you develop specialties by accident, just because you're interested in something or your background happens to be suitable for it, and so you kind of pseudo specialize in it. But my goal really is to not be a specialist and to kind of be able to cover, say, 5 to 10 different types of markets, right? So that I'm not married to any market, right? I can like copper and then not like copper. I can like American stocks and then think they're overvalued. I can fluctuate around, and there might be, the framework might tilt me towards being more structurally bullish on certain areas, but I'm still happy to say this has gone really far, really fast. So, I'm going to rotate out of this a little bit, going to here, not because I'm a market timer, just because I track valuations, I track, things that are maybe too full of sentiment. And so, I think that's a really good point, is you want to find analysts, if they are specialists in their area, that have made calls to the other direction as well.